Exactly what happened. Silver ripped higher again, smashed through the low 90s, and in the middle of the trading day it flirted with the kind of number that makes markets nervous. Not someday nervous, today nervous. Around the world, exchanges started tightening screws. Dealers started changing their quotes in real time, and regular people started asking the same question at the same time. Is this the moment the silver market finally breaks out of the cage? Because when silver is moving like this, it isn't just a price chart, it's a stress test. And today's stress test was loud. I'm John Agg. As this is being recorded, silver has been trading near $93 after an explosive run that's been building for months. If you felt like the move came out of nowhere, that's the point. These are the kinds of squeezes that look slow right up until they don't, and then suddenly the headlines show up after the money already moved. Now here's the part that should get your attention immediately. The people who run the casino are trying to make the casino more expensive to play. In plain English, a major futures venue has been hiking margin requirements on silver contracts. That means it costs more cash to hold the same position. And whenever you see that happen in a fast market, there are only two honest interpretations. Either they're trying to calm volatility so the system doesn't wobble, or they're trying to force weaker hands out because the move is going in the wrong direction. So the question is simple. Which one is it? Because if the goal was stability, you'd expect the market to cool off. But that's not what's happening. Price keeps pushing. People keep showing up. And the more the rules get tightened, the more it starts to feel like silver is doing that thing it does in rare moments, ignoring the gatekeepers. And if you're wondering why this matters to you, even if you never touch a futures contract, stay with me. This margin story is the first domino. The next domino is retail. And the domino after that is supply. And supply is where things get uncomfortable. Before we go any further, quick note. My channel analytics keeps screaming something at me. A huge chunk of you who watch these videos regularly still haven't subscribed. If you get even a little value out of this, anything that helps you think clearer, protect your money, or spot what's coming, hit subscribe right now. Our target is 50,000 subscribers in the next 30 days, and you're a big part of whether we get there. Also, we've started uploading exclusive videos for our premium members. You can join us via link provided in description. Starting from $14.99, a fully dedicated team is making an even deeper research for these videos. All right, let's get back to the fire. When silver runs, you usually see three battles at once. Battle one is paper positioning. Leverage traders, option expirations, margin calls, forced liquidations. That's the screen. Battle two is physical reality. Bars, coins, scrap, delivery, refinery capacity, and the awkward fact that you can't print metal. Battle three is psychology. The moment normal people start saying, wait, should I own some? Most people stare at battle one and forget the other two exist. But the real explosions happen when battles 2 and 3 sync up. And right now, they're trying to sync. One of the most interesting tells in this move is how the contract sizes are being repackaged to steer behavior. When you see smaller contract sizes pushed into the spotlight during a mania phase, it's usually an attempt to redirect traffic. It sounds friendly. More access, smaller units, more participation. But it can also be a pressure valve, trying to keep retail enthusiasm contained inside a product that's easier to manage. And at the same time, margin rules are shifting from simple dollar amounts into percentage-style requirements because the price is whipping around so hard that the old system can't keep up. That alone tells you the move is not normal. If you've ever watched a market get tight, really tight, you learn something important. The price isn't just a number, it's a signal. And when the signal gets loud enough, institutions stop pretending. They adjust the rules. Now let's move from paper mechanics to the physical street level, because this is where the story gets real, and where you can feel the pulse without needing any fancy terminal. When silver is climbing fast, the official mints and the big-name retail distributors start acting strange. Product pages go blank. Out-of-stock banners multiply. Items disappear and then reappear with new pricing a day later. Shipping dates stretch. Allocations get rationed. And the biggest tell of all, the premium over spot starts doing things that don't match the headline price. You might see spot at $93, but you go to buy a basic ounce and suddenly it's $101, $103, $105, depending on what you're trying to get and who can actually deliver it. That gap is not decoration. That gap is stress. And stress always reveals the truth. In a fast market, the physical supply chain becomes a funnel. Silver doesn't teleport from the earth into your hand. It goes through miners, refiners, fabricators, wholesalers, and dealers. Every one of those links has capacity limits, and when price surges, two waves hit the funnel at the same time. Wave one is sellers, people who've had old coins, jewelry, flatware, and junk silver sitting in drawers for years suddenly decide to cash in. Wave two is buyers, People who didn't care at $25 start caring at 70, and people who started caring at 70 start panicking at 93. Both waves jam the same narrow pipeline. And that's why you can see something that confuses beginners. Lots of people selling, yet premiums rising. How can there be a shortage if everyone's bringing silver in? Because the bottleneck isn't silver exists. The bottleneck is silver gets processed. Refineries can only handle so much input at once, and they have preferences. If you bring them low-purity scrap, it can take more time, more steps, more headaches. In a surge, they'll prioritize what moves fastest. That can leave piles of lower-grade material waiting, even while demand for finished products is screaming. So dealers sit in a weird spot. They're seeing incoming metal, but they can't convert it into sellable inventory quickly enough. And that's when premiums inflate. Now here's something most people miss. Premiums don't just rise because of greed. They rise because replacement becomes uncertain. If a dealer sells you a pile of ounces today, they need to know they can replenish. When replenishment takes weeks or months, the price you're paying includes the risk that the shelf might stay empty. And empty shelves create the most dangerous emotion in markets: urgency. You've probably noticed that when price spikes, some dealers quote wide, some quote conservative, and some simply stop quoting. That's not because they don't like your business. That's because in a runaway market, the fastest way to go bankrupt is to sell inventory you can't replace. So let's put a spotlight on what's happening right now at the grassroots level. In the last few weeks, foot traffic at many local coin shops has started to change. You still have the classic sellers with boxes of old silver, but you're also seeing something more important: first-time buyers. The "I've never bought metal before, but" crowd. That's the crowd that turns a steady bull market into a chaotic one, because sellers are finite. Everyone has only so many drawers to empty. But buyers? Buyers can multiply. And retail buying is the thing paper markets fear the most, because retail buying isn't about leverage. It's about taking metal out of circulation. Retail buying is sticky, and sticky buying is how squeezes become headlines. So if you're trying to understand why the big exchanges would tighten margins, you have to think like the risk managers. Their nightmare isn't silver up $3. Their nightmare is silver up $3 while physical drains. Because once physical drains, paper promises start looking less comfortable. And this is where the conversation gets even spicier, because there's a second layer that's been whispered about all over social media: big short positions getting clipped. When a big player shorts silver, they're basically betting that price will go down, or that they can manage risk if it goes up. In normal times, they hedge, they roll, they dance. But in abnormal times, abnormal things happen. Stops get hit, losses get realized, and sometimes a trade becomes too big to hide. There have been reports circulating about major stop levels around the low 90s area. If those levels were real and they got triggered, that's not just a bad day, that's forced buying. And forced buying in a tight market is gasoline. Now, I'm not here to verify rumors line by line today. The bigger point is this: the market is behaving like a system under pressure. You can feel it in the way margin rules are changing. You can feel it in the way product availability is changing. And you can feel it in the way people talk about it, because suddenly everyone has an opinion. And when everyone has an opinion, the move is already mainstream. But here's the twist: mainstream is late. The real move often happens after the first mainstream wave, when the system tries to cool things down, and then the next leg higher arrives anyway. That's why retention matters right now, because the next leg doesn't usually announce itself politely. It arrives when you're distracted. And I want you to keep one specific mental picture as we go forward. 2 clocks. Clock 1 is the chart clock: candles, dips, bounces, headlines. Clock 2 is the inventory clock: weeks of lead time, refinery backlogs, mint delays. Most people only watch clock 1, but clock 2 is the one that detonates surprises. Now, I spent time recently talking with a seasoned metals dealer who also spends a lot of time educating people about sound money. He's on the front lines, watching transactions happen in real time, and what he described is exactly what you would expect in a silver surge, except more intense. He said the shop can go from quiet to non-stop in a matter of hours. Not because of one whale, because of volume. Many smaller transactions stacked on top of each other, plus constant incoming scrap. And that's the part that sounds healthy at first, until you realize what it does to the system. If a shop is buying a mountain of silver from sellers, that seems like supply is pouring in. But if at the same time the shop is selling to new buyers, that means silver is changing hands, and often leaving the market in a more locked-up form. And locked-up metal doesn't flow back easily. A seller sells because they want cash right now. A buyer buys because they want protection for years. Those are not symmetrical motives. So even if you see a glut of scrap on the selling side, it can still translate into scarcity on the finished product side because the converting process is slow and the new holders don't flip it back quickly. And that's why you can see an environment where a dealer can say, "We're buying a ton," and also say, "It's getting harder to restock." Both can be true at the same time. Now let's talk about premiums abroad, because this is another clue that a lot of people ignore. When you see higher local premiums in certain overseas markets, meaning buyers there are paying significantly more per ounce than buyers somewhere else, that's a sign of uneven distribution, different demand intensity, and sometimes restrictions that distort the flow. It can also be a sign that physical metal is being bid up where it's hardest to obtain, which is a whisper of future stress elsewhere. So if you hear about premiums in one region running far above another, don't just shrug. That spread is information. And spreads like that don't stay quiet forever. They either normalize or they widen and become the story. Now here's where we need to talk about the supply chain in a way that most channels won't, because it's not as flashy as a chart, but it is the heart of the matter. When price rips higher, refineries get slammed. They get slammed by inbound material from the public, and they get slammed by downstream demand for fabricated product. But their capacity doesn't double overnight, so they triage. They prioritize higher purity. They prioritize material that can be processed quickly. They prioritize relationships, because in a shortage, relationships are everything. And that's why some networks are able to keep minting even when big-name products vanish. If you have dedicated refining slots and prearranged capacity, you can still get product out. If you rely on the open market for refining time, you can get stuck in line. That's not a conspiracy. That's logistics. And logistics is ruthless. Here's a quick scene that captures the mood. A customer walks in with a small canvas bag that's clearly been sitting in a closet for years. Inside are mixed coins, a couple of worn bracelets, and a stack of old rounds. 10 minutes later, another customer walks in with a totally different energy. Phone in hand, chart pulled up, asking, "Do I still get it close to spot, or is everything 10 over?" The dealer answers with the only honest response in a fast market. "It depends on what I can replace tomorrow." That's how you know a market is transitioning from normal to urgent. And here's the sneaky part. The public usually notices the price first, but the professionals notice availability first. Price can be argued. Availability can't. When you see delivery dates stretch from days to weeks, when wholesalers start quoting allocation only, and when a product suddenly becomes call for pricing, that's the market whispering that the next phase is closer than it looks. So keep your eyes on the boring details, because the boring details are where the truth leaks out. And one more thing. If you're hearing friends say, "I'll wait for it to come back," ask them what they mean. A lower number on a screen or actual metal they can still buy today? Add that perspective to your plan because it keeps you calm and stops you from chasing when things get loud. So if you've been watching the market and wondering why some items are available and others are impossible, this is a big part of the answer. Now, let's bring this back to you because I know some of you are thinking, "Okay, but what do I do with this?" First, understand what kind of market this is. This is not a calm, polite, low volatility market where you can wait for the perfect entry and get filled quietly. This is a market where gaps happen. This is a market where you can wake up and see the price $5 higher and the inventory $10 higher. And in markets like that, the most common mistake is chasing emotionally. So instead of telling you to chase, I want to give you a framework. There are two categories of people watching this. Category 1 is already positioned and wants to know if they should sell. Category 2 is not positioned and wants to know if they missed it. If you're in Category 1, the question is, what is your time horizon and what is your purpose? If your purpose is long-term protection, you don't let a fast move trick you into doing something you'll regret later. Fast moves often include brutal dips. If you can't handle dips, you should size accordingly, not panic accordingly. If you're in Category 2, the question is, do you want exposure or do you want a perfect price? Because markets rarely give you both. If you want exposure, you can enter in a disciplined way rather than in one emotional bite. And yes, there can be violent pullbacks. Options expirations, margin hikes, liquidity squeezes, these can create sharp downdrafts. But here's the key. In a true bull phase, pullbacks are often shorter than people expect because dips get bought. And the reason dips get bought is because the underlying forces, currency debasement, risk hedging, industrial demand, and geopolitical uncertainty, don't take a day off. Speaking of uncertainty, let's zoom out, because silver doesn't move in a vacuum. It moves in a world that's feeling more fragile by the week. When people feel the ground shifting, when they see tensions, sanctions, conflicts, instability, they reach for things that historically survive. And metals are the oldest version of that instinct. You don't need to agree with every narrative you see online to understand the behavior. You just need to understand incentives. People want assets that don't require someone else's promise. That's why, during turbulent periods, you see capital flowing toward hard assets. And once capital starts flowing, it tends to keep flowing until it hits an extreme. Now, if you want a simple indicator that retail is waking up, watch the gold-silver ratio. When silver is sleepy, the ratio stays elevated. When silver wakes up, the ratio drops. That ratio is like the market's way of saying silver is catching up. And lately, it's been doing exactly that. Now here comes a cliffhanger that you should not ignore. If the ratio keeps compressing, silver doesn't need to go a little higher. It can go a lot higher. Because ratio compression doesn't move in baby steps when the market gets crowded. It can sprint. And that's why you're hearing bold targets thrown around. Some are conservative, some are wild. But the presence of bold targets is not the story. The story is why people feel comfortable saying them out loud. That confidence is a symptom. Now let's talk about something that sounds boring, but is actually one of the most viral drivers: inventory visibility. When people see sold out, they share it. When they share it, more people look. When more people look, more people buy. And suddenly, you have a feedback loop. That's how retail frenzies start. Not with one big announcement, with many small proof points that circulate through screenshots and group chats. And yes, group chats matter now. Which is why, by the way, you'll find bonus links in the description, including access to a premium WhatsApp channel where we share updates, breakdowns, and the kind of quick notes that don't always fit neatly into a public video. If you haven't checked those links yet, do it after the video. They're there for you. Now, while we're on the subject of deeper content, I also want to mention something we've been building quietly: members-only videos. These are not just extra uploads. We have a separate team working on those, doing deeper research, tighter charts, and more extensive sourcing. And that content is reserved for premium members. If you want the longer form, more detailed breakdowns, without the noise, check the membership option. It directly supports the research, and it unlocks the members-only library. All right, back to silver. One of the most surreal scenes in a fast silver market is watching old, high-end household silverware get treated like scrap. Decades ago, it was status. Now, in a rush, it becomes feedstock. People bring in heavy sets, beautiful pieces, family heirlooms, and the decision becomes purely financial. Converted into cash or into new bullion. This is how a bull market pulls metal out of the past and forces it into the present. But even that isn't enough to satisfy a true surge, because the world's appetite for silver is bigger than grandma's drawer. Industrial demand isn't sentimental, it's functional. And when industrial demand collides with investment demand, the supply chain feels it in its bones. Now, here's another cliffhanger. The current tightness doesn't require total depletion to cause chaos. It only requires timing mismatch. If demand spikes today and supply can only catch up months from now, you get a squeeze without ever truly running out. You get long lead times, rationing, and widening premiums. And you can get that even while scrap is pouring in. So when someone says, "There's plenty of silver," ask them, "Plenty where, in what form, and deliverable when?" Because silver exists is not the same as silver is available. Now, let's talk about what happens next, because this is where the story gets dangerous and where a lot of people lose money psychologically. In a manic phase, the market will try to shake you. It will spike, it will dip, it will fake you out. It will tempt you into thinking the move is over, and then it will rip again. And exchanges know that. That's why they adjust margins. They're basically trying to engineer a shakeout. But the problem is, when a move is driven by structural flows, shakeouts often become opportunities for stronger hands. So even if you see a nasty dip, 30%, 40%, the question won't just be, did it dip? The question will be, did the physical drain stop? Because if the drain continues, dips don't last. And that brings us to the retail trigger point. There is a psychological threshold that changes behavior. For silver, round numbers matter. When silver prints triple digits, when it flashes $100, the conversation changes. People who ignored it feel embarrassed. People who wanted to buy later feel late. People who already own it feel vindicated. Media outlets start calling it a mania. Friends text friends. Coworkers bring it up at lunch. And when the conversation changes, demand changes. That's why the run to $100 is not just about the number. It's about what the number does to the crowd. So let me ask you a direct question, because I want you in the comments. When silver hits $100, do you think the average person buys or sells? And second question, what do you think breaks first? Paper pricing, dealer inventory, or the public's patience? Drop your answers below. I read them, and we pull ideas from them for future videos. Now, there's something else I need to do today because this community deserves it. We got a comment recently from one of our premium members, and it's exactly the kind of real-world story that shows why preparation beats prediction. The premium member is George Peterson. And George, first of all, thank you. Here's what George said, and I'm going to paraphrase it while keeping the message intact. He told us that yesterday was his first day watching the channel. He heard the warning that the next trading session could open with a dip because of options expirations. He also heard the argument that silver miners, especially the miners, looked undervalued. So in the early hours, he used the cash he had available and placed 2 low-ball limit orders on miner ETFs. Then he shared the results. One position moved up a couple percent while he was up more than 3. The other moved up under 2% while he was up nearly 6. And he said the gain more than covered a full year of membership to the premium channel because he got filled close to the low of the day. George ended it by saying thank you again and that he's looking forward to the next commentaries. George, that is awesome. And it highlights something simple. When you have a plan, you don't need perfect timing. You just need discipline. And for everyone watching, this is why we do members-only research, because a small edge applied consistently can pay for itself. Now, let's pivot back to the broader narrative, because silver isn't just a metal story, it's a currency story. When currencies get diluted, hard assets reprice, sometimes slowly, sometimes violently. And the last few years have been a masterclass in dilution. Liquidity injections don't show up instantly. They move through the system like a slow tide, and then one day people look up and realize their purchasing power has been quietly drained. This is why you hear so many people say, everything costs more, because it does. And metals are one of the few places where that reality gets reflected quickly. So when silver is running, it is not just speculation. It can be the market's way of marking the damage. Now, there's another angle that adds fuel, and it's the capital rotation story. When investors start losing faith in paper assets, overvalued stocks, stretched real estate, low-yield bonds, they begin rotating. At first, it's subtle. Then it's obvious. And once the rotation becomes obvious, it can last years, not weeks. This is how long bull markets in metals can happen. They don't need a constant stream of good news. They just need a constant stream of distrust. And distrust is not in short supply. Now, I want to bring you back to the street again for a moment because it's easy to talk in abstractions. But the clearest signal is always what people do, not what they say. When a local dealer tells you, "We sold out of most gold," that's a signal. When they say, "Silver is harder to keep on the shelf," that's a signal. When they say, "We're getting first-timers," that's a signal. And when they say, "Lead times from wholesalers are stretching," that's a signal. Those signals often appear before the biggest price moves because price is the last thing to adjust. The system tries to ration with delays and premiums first. So if you're only watching spot price, you might miss the early warning. Now, a quick creative side note, because some of you ask for inspiration and real stories. If you want silver-related success stories, the kind where you see how ordinary people built positions, took profits wisely, or used a plan to change their finances, there's a link in the description to a separate channel focused on that. Give it a look and subscribe over there too. It's a different vibe, but it's packed with practical stories. All right, now let's talk about where this could go, because I know you want numbers. Here's the honest answer. Targets are less important than dynamics, but dynamics can imply targets. If silver has already pushed into the low 90s, the move to $100 is not a fantasy. It's a psychological stepping stone. From there, you start hearing 150, 200, 250. Some analysts talk about 300. Some go even higher. The exact number isn't the point today. The point is that once you break a major psychological barrier, the market can enter a phase where each leg up is met with bigger participation. And the more participation, the more volatility. So you should mentally prepare for whiplash. Now, if you're wondering how this ends, there are a few classic endings to metal bull phases. Ending 1. A broad market crash forces liquidation of everything, including metals, temporarily. Paper price drops, physical premiums stay stubborn, and then metals recover faster than most assets. Ending 2. The system changes the rules. Cash settlement, delivery restrictions, emergency measures, creating chaos and distrust. Ending 3. The move exhausts itself in a euphoric peak where everyone is convinced it can only go up, and then it collapses. But often from a far higher level than where it began. Which ending do we get? We don't know yet. But we can watch for tells. Margin hikes are one tell. Product shortages are another. Ratio compression is another. Retail participation is the big one. So as we approach $100, watch how fast the retail wave builds. Because if it builds fast, the next phase can get wild. Now, let's address a common myth. People say, if silver is so tight, why can I still find some? Because markets don't go from available to impossible overnight. They go from available everywhere to available in pockets to available only at a price to available only if you're connected. And the transition phases are where confusion lives. So if you can still find silver, that doesn't disprove tightness. It just tells you we're in a transition phase, not in the final scene. Now, let's talk about one more thing that adds to virality: social proof. When new buyers walk into a shop and see other buyers there, they feel safer buying. When they see empty trays, they buy faster. When they hear that wholesalers are backlogged, they buy now. And that social proof can create self-fulfilling shortages. Not because the world has zero metal, but because the flow slows while demand spikes. And that is enough. Now, if you're new here, I want you to understand how we approach this channel. We don't do blind hype. We do pattern recognition. We look at the signals, we look at incentives, and we talk about positioning with realism. And part of realism is admitting that if you're late to a move, the worst thing you can do is let emotion drive your first step. So if you're considering exposure, consider building it in layers. Consider using limit orders on related assets if you're playing the equity side. Consider learning before you leap. And if you want deeper breakdowns, again, the membership content is there. Now, as we close in on the $100 question, I want to leave you with a final cliffhanger that you should keep in your mind this week. The market is not just fighting over price, it's fighting over credibility. If silver keeps rising while exchanges keep tightening margins, the public starts asking, why? And once the public asks why, they start learning. And once they start learning, they start acting. And once they start acting, the metal moves from weak hands to strong hands. And when that transfer happens, the market becomes harder to control. So the real story isn't just whether silver hits $100. The real story is what happens after it does. Does the retail wave explode? Do premiums detach even further? Do exchanges introduce more stabilization measures? Do the headlines suddenly flip from bubble to shortage? Because those are the moments that define the cycle. So here's what I want you to do. If you're watching and you're not subscribed yet, fix that. Help us hit 50,000 subscribers in the next 30 days. It takes one click and it tells the algorithm this content matters. Then check the description for the bonus links, including the premium WhatsApp channel. And if you want the deeper research team content, consider becoming a premium member so you can access the members-only videos. Finally, tell me in the comments, when silver prints $100, what's the first headline you think we'll see? And what's the first emergency move you think the market makers will try? I'll see you in the next video again.